Hello.
Hi.
Welcome back.
Here we are.
How have you been?
Did you go right from the last video, or did you take a break?
In our third video, we are going to cover some of the more complicated aspects of our investment philosophy. This is our principles. This is not why we covered why we invest. We covered how we invest. We covered sort of the basics of compound interest. But now we're going to talk about the mechanics of portfolio construction.
So the four main topics that we're going to be covering during this video is why we should trust the markets, right? Because the markets can provide returns that we need to reach our goals. We don't need to try to beat the market by picking individual stocks. We're going to talk about why diversification is your friend. It's a good idea to diversify, but why? We're going to talk about that. How to optimize your portfolio's return. So after accepting that we are going to diversify and take the overall market, is there anything else we can do on top of that to potentially increase our returns? We're going to explore that later. There's some cool research that shows that there is opportunities to do that.
And finally, we're going to talk about why humans are poor investors. We are emotional creatures. We react to things. It makes us some of the best innovators on the planet. We own the planet, but it doesn't make us good investors. So we have our jar of magic jelly beans, and there was a study done where individuals were asked, how many jelly beans do you think are in this jar? Maybe you've played this game with your first grader before. And most people guess around 1,600. There's a wide range, of course. Some people guess way too low. Some people said 409. Some people guess way too high, and they said 5,365. But essentially, the average of all the guesses was the actual number. So if we trust our collective intelligence as a whole, we're going to get pretty close to the right answer.
What are we even talking about jelly beans for, right? Trusting the market. It's because we're talking about pricing things. In the future slides, we're talking about picking the actual price of a stock, right? Because if you think that a stock's worth is valued at $100, but you think it's worth $130, you would buy that one, right? Or if you think it's actually worth $70, then you would sell that one, or you would short it to make a profit. This is just an anecdotal way of showing that the market as a whole is really good at guessing the actual real price of stocks. Like those jelly beans is 100 people try to guess the average value of a jelly bean. Well, in the stock market, there's a lot more people with a lot more expertise that are trying to guess the accurate prices of stock markets and stock prices, and their whole jobs are on the line, and they do it all day, 100 hours a week for decades and careers, and there's $500 billion of value exchanged every single day. So we're not just guessing here.
It's a lot of jelly beans.
Buying and selling these things every single day, like actual wealth being transferred. So it's going to enhance the accuracy of those guesstimates when there are consequences. What goes into a stock's price anyway, right?
Jelly beans?
No. So
trying to keep it light here, guys. Come on.
All available information in the world, whether that's the number of cicadas that are coming out of the ground in New Mexico in September of this year, or that's the exchange ratio from yen to US dollars, or it is the amount of gold that was discovered in a new mine in Western Australia, or it's consumer optimism about iPhone prices. All that information is public, and it's analyzed by millions of people trying to guess the accurate impact that information is going to have on the value of different companies. And anything can happen any day of the year. The news cycle is never ending, and it's 24/7, whether it's a CEO getting fired or somebody getting canceled, or a new fungicide isn't working, or a new president comes on board, or whatever it is, the markets react. And they impact the changing value of prices, and they happen every single day relentlessly. So there are, like I said, millions of professional investors that are watching these cycles all day, every day, that are changing their buy and sell orders and their clients and their own allocations when they've got real money on the line and their careers depend on it, to buy and sell these things and exchange them for new equities and new bonds that are going to perform better or worse than the current things that they own. So since things are moving so fast, and there's so many ways different things can move, and how we digest it and how that fits into your own asset allocation, it's really hard to digest all of that and to constantly stay in the right lane. How do we switch lanes? Pepsi was doing great in the past, now Coke is doing better, based on prices, performance, legislation, their equity, their executive team, new markets. Anything can impact either of these decisions. Can you make those decisions every day about which lane is the fastest lane across your whole portfolio, while keeping all the things that we've discussed in prior videos in mind? It's a very hard thing to do. And we can see from evidence that it actually hurts you to do that.
So it's really hard to stay in the fast lane. And in fact, the professionals who have made their entire careers trying to stay in the fast lane, trying to pick the winning stocks to meet a certain benchmark of performance, even they fail. In fact, over a 20-year time horizon, 60% of them fail. Only 23% of them are winners, which means that you're going to be a winner because you're going to just stick with the market. You're going to put your faith and trust in the market. You're not going to rely on picking individual winners. You're not going to rely on trying to stay in the fast lane. You're just going to let it ride.
So you can either swim upstream against the market to try to beat it, right? Like the folks on the last slide, the professionals, or you can ride the wave, right? You can enjoy the market returns and what they provide, and they have provided significant returns in the past.
Rolling with the homies. In the US, you might think of as the strongest economy. You know, we contribute a lot of the wealth in this world, but actually we only make up 54% of the equity market. So when we're talking about diversification, we want to make sure we're not 100% concentrated in the US because we're missing out on half of the world's ability to create wealth.
So studies show that diversification not only reduces risk, but it also increases returns over the long run. So academics call it the only free lunch in investing. Diversification is a no-brainer. We just don't put all of our eggs in one basket. It's just that easy. And here's, to put our money where our mouth is, here's some examples of why diversification is really important to capture the whole market. Because if we miss out on just a few high performers, high flyers in the market, then we can miss a lot of the biggest opportunities. For example, we have a study that showed over a 24-year period from 94 to 2018, that if you invested in all stocks in general, you would have about a 7.2% return over that time period, over that time horizon. Whereas if you just excluded just 10% of the top performers over that time period, your return would only be 2.9. So you're going from a rate of return that allows you to reach financial independence, as we've discussed in prior slides, to one that's not, or it's going to increase your working life. So if you're just missing out on the top 10%, then you're going to have a very small rate of return. You're really shooting yourself in the foot by not picking the right stocks. And look, if you exclude the top 25%, if you're diversified across 75% of the market, that means you've got over 2,000 stocks, and you can say, I am broadly diversified. Of course I am. Look at me, I got 2,000 stocks. But if you miss the top 25% of them, you're going to have negative rates of return. You're going to be losing money. You're going to be saving money now and having less money later, delaying gratification to no avail. So it's one of the big reasons why we diversify totally here. And not only is it going to help with performance of your portfolio, but it's also going to make it easier on your psyche, because if you own three, it's going to smooth out the bumps of the stock market or of the individual stock values that you own, right? Your portfolio is going to bounce around in value a lot less, which is going to help you sleep at night, and you're going to have more confidence in your plan. Just to illustrate that, if you had three different securities that were performing erratically, which all securities do as compared to the market, which you can see on the bottom, you would have a much bumpier ride on the top. With diversification, you're going to have a much smoother ride up and to the right. And to drill down into that, not even just in securities, but to zoom out to like mutual funds, let's say. So those were just three securities. Let's talk about different asset classes in the mutual funds that you can invest in and how to diversify across those. We have a period of 2004 to 2018 on this chart, and we can see the S&P 500, top 500 US equities, and then we've got the Russell 2000, which is the bottom 2000. So we got big companies, small companies, international, emerging markets, all the asset classes that you can invest in on this chart. And you can see the highest performers on the top and the lowest on the bottom, and it looks random.
Yeah, so pick a color and follow along. Let's pick light yellow, and we can see that in 2004 it was up 33.9%. In 2018, we can see it was down 18%. So it's all over the place. It's bumping up and down. If we're diversified, we're invested in every asset class on this chart, we're gonna have a much smoother ride as we go up.
Smoother ride, higher returns. Now we're going to talk about how, with a diversified portfolio, how we might be able to optimize that portfolio a bit to add some returns rather than just accepting what the market provides.
We told you to trust the market. Now we're going to tell you how to trust the market in a slightly optimized way.
How to tweak the market. So what are the actual resources that go into a company and that produce the profits that they spit out? Well, it's the resources. It's the labor of people that work at companies, such as you and AJ and I, and the tools that they use, the knowledge and the materials of their staff All right, and then they are injected with financial capital, whether that's raised via stocks or bonds or loans, or from capital contributions from the owners. They use all of those tools together to produce the profits that we need. Well, companies need money, right? They need money to, come up with R&D money. They need money to break into new markets, develop new products, what have you. And you're participating in that, and you are going to be providing money, whether that's via making loans with a bond. When you purchase a bond from a company, you give them money, and they pay you interest over a period of time. And they pay you back the principal at the end, right? So that's how bonds work, which we've covered in prior videos. And then with stocks, you are accepting an ownership interest in the company. So you put money in, and then they will kick out either a return on the investment or some dividends down the line. Okay, so of those companies that we've decided to invest in, how are we going to choose them? We could accept the market, right? But research has shown that there are certain premiums that we can participate in if we tilt the choices that we make across our broadly diversified portfolio towards certain types of equities and bonds. Equities have provided higher returns than bonds over the long run. That's what the market premium is. So if we want to increase returns, we would choose equities over bonds to begin with. Okay. The second thing that we would look at is company size. Generally, the smaller a company is, the more room it has to grow, and they produce higher returns. The other premium to look at would be the relative price of a company. So if a company is cheaper, generally there's more room for that company to increase in price, right? If you have two identical companies and one of them is $10 and one of them is $20, if they both go to $30, which one has produced more return on your investment? The last one is profitability. Companies that are similar, but one of them has a higher profit margin than the other, seems pretty obvious that one's going to produce higher returns over the long run. So you combine all of these premiums, and there's an opportunity to increase your returns and still be broadly diversified and pay low expense ratios.
Yep.
All right, so what does that look like to tilt your portfolio or to select those premiums that we just talked about on the prior slide, right? So we're gonna select smaller companies that are more profitable, that are less expensive. What would that look like? So all the way on the left here, we just have all companies to choose from, right? So we got all the marbles on the table.
Yeah, so each little black dot represents a single company.
And now we're going to dissect this. We're going to say, all right, of all these companies, let's pick the smaller ones. Let's compare the larger ones to the smaller ones. That's what we're doing on the second section here. And the yellow is us choosing. These are the ones that we're going to put into the portfolio if we wanted to select smaller companies. And then the third graph, we're then going to look at the price, right? So we're going to dissect this again down the middle, and we're going to see which ones are cheaper, okay, value companies, versus more expensive companies, which are called growth companies. The value companies generally pay dividends and they're less expensive. Growth companies don't, and they are more expensive. Most tech companies, like large tech companies, are growth companies, right? They don't pay dividends, they just reinvest all the money into their technology, and they're very expensive per share that you purchase as compared to value companies, which are older, generally, more old school companies, Berkshire Hathaway, and they spit out dividends a lot. Mm-hmm. So if we're gonna dissect this down the middle, now we're now gonna not choose the growth companies, but focus on the value companies. So the ones in yellow on the left are now what we're gonna concentrate on. And now finally, across those three different choices, we're choosing equities that are smaller and relatively cheap. We would then opt into the more profitable companies across the whole matrix of choices here.
Yeah, so essentially we took the four dimensions that we talked about in the last slide and applied them to all of the companies in the market. And here, all of these little gold dots are the companies that we have identified as the ones we want to invest in. The other ones we think are either too large and too overvalued, or they're too small and they're not going to perform as well. They don't have those big profitability margins, so we're just not going to invest in them. We're going to pick the best ones. That's what we've decided here. This is what we mean by pursuing dimensions in a portfolio.
Here's another way to visualize all those dots, right? But with actual ticker symbols. Let's put names to the dots,
yep.
Right? Why are they sized differently? Well, it's just the value. It's the relative value. So Microsoft is a giant company, right? Mm-hmm. It's much bigger than all the other ones on the graph. So that's what they would look like if you were to compare their size. If we were to just show you sized companies, this is what it would look like. The majority of companies are small growth and small value. So we're just trying to illustrate here what the stock market actually looks like if we were to visualize it.
Yeah, there's a lot of companies out there that are on the stock market that don't make headlines, but they're very solid investments. They're good valued companies. So we're going to make sure that we're investing in the companies that are going to produce the best results for us.
Yeah, the stock market in general is on the right here. Okay, so we got equal weights between large, middle, and small companies. But if we were to tilt our portfolio towards smaller, more highly value-focused rather than growth companies, we would have a portfolio that looks like the one on the left, which would be a smart tilt towards those smaller, more valuable, or more value-focused and profitable companies.
Yeah, it's subtle here, but you can see actually how the small value and small blend are actually a much bigger percentage of the overall portfolio on the left-hand side.
So what each one of these bars is the return of value minus the return on growth companies. Essentially, how many times have value companies outperformed growth companies over a 10-year investment history? And everything in the blue is the times that they have outperformed, and everything in the red is the times that they have underperformed. So obviously there are a lot more blue bars here than red ones. So value just has historically a much higher return on investment than growth companies has.
Yeah, and we're talking about value, we're looking at the long-term horizon. Growth companies, if we look over the past 3 or 5 years, they're gonna look like they're doing a lot better. Value, we have to be more patient. We are investing for our future, our financial independence. So we're gonna see those higher returns over a longer period of time. Unfortunately, the biggest hurdle between you and financial independence is your ability as a human to make emotional decisions. So humans are not wired for investing. If you could see some of the quotes on this lovely brain image, or maybe things you've thought of before. I wasn't wrong about this stock, I was just unlucky. I have a proven system for picking winning stocks. My research confirms this is a great stock to own. Or I work at this company. I know that there's a product coming down the line that's going to make the stock go up. These are all things that we've maybe thought about before. These are not good philosophies to implement in our investment strategy. And look, investing is emotional. You're going to watch your hard-earned money in your portfolio go up and down. You're going to go through cycles of feelings, just as the US economy goes through economic cycles of increase and recession. So you're going to feel optimistic about your portfolio. You're watching it go up. We've experienced that over the past decade. We had a big recession in 2008, and since then we've seen pretty impressive growth. This has been one of the longest bull runs in history. I would venture to say that right now we're in a period of nervousness. Today on November 5th, 2019, because we've been on this long bull run. We've seen stocks basically go up and to the right for the past 10 years. But now people are starting to get a little nervous. Maybe they're feeling a little overconfident, and maybe we're heading towards this point of fear. There's maybe a recession coming. And then we're just gonna go back on the cycle again.
So reacting to your fears and your nervousness can have big negative impacts. That's how we lose out that 3% that I just referenced, is because we might move our asset allocation, move out of the market for a little while, or choose not to put a certain amount of our extra cash into the market because we start to get nervous. And just like moving to cash would hurt you, getting out of the market in general can hurt you. And we can see we're putting our money where our mouth is again. Here's the statistics and the actual numbers on it. So from 1990 to 2018, we can see that the stock market had about a 9.2% return on investment. So that's fantastic. It would definitely help us reach our goals quickly. But if we miss just the one best day of that period of time, when we lose out on about a 0.5 percentage point of return, which doesn't sound like a lot, but if you watched our last video, you can see that the power of rates of return can have a huge impact on our ultimate wealth at the end of the day. So we're always trying to maximize that rate of return. Here we've got 1970 to 2018, and a lot of things have happened from 1970 to 2018. A lot of things that would make you question the stock market and shake your confidence in whether or not we're going to continue to see capitalism do its thing and provide the returns necessary. We got oil embargoes, we've got Great Recessions, we got 9/11 on here, we got a lot of things that are shaking people's confidence. But over that period, $1 has become $54. So the market has rewarded discipline. It has not rewarded people moving in and out of the market. It has rewarded staying patient, staying the course.
So we covered a lot today. We talked about putting your faith in the markets, trusting the markets. We talked about how diversification is your friend and how it's the only free lunch in investing. We talked about how to optimize your portfolio's returns by having that tilt towards smaller value companies. And finally, we talked about how humans are not the best investors because we are emotional creatures. And we're trying to take the emotion out of it, just get the money in the accounts and let it ride. And you'll be reaching that financial independence goal sooner than you think.
All right, let's ride.
Let's ride.